I forgot my presentation, so I'll be just as surprised at what we see here as you are. But the point of what I'm talking about, and first of all, thank you, Nicholas, for having me again. I really appreciate it. The point of what we're talking about is Joachim did a fantastic job talking about the market dynamics. I'm going to talk a little bit about how investors are thinking about those market dynamics and how they're thinking about putting money to work within the shipping space, with a primary focus on public equity and debt investors, but also private investors as well. So with that said, and you can sort of see what the title here is, and I'll move it forward one as well. I think this, from our good friend Dante and his Divine Comedy, lays out how many investors think about shipping as if they are going into the gates of Inferno, into the gates of hell, when they're making shipping investments. That's the current typical approach. There's a lot of skepticism and not to say that they don't do it, certainly, but certainly more caution, I think, than there had been in the past. And there's a good reason for that. Let's see if we can move forward one here. There we go. So here's a good reason for investor caution. If you look at 2019, it was almost across the board fantastic. You can see the returns for LPG shipping, crude tanker shipping, and these are public equities. If you would have invested in almost anything within shipping last year, you probably were going to do certainly better than the market. And that's great, it's very exciting. And then not so much in 2020. As all of you here know, this is a pretty volatile and cyclical business, and that over the 15 years that I've been working with public investors in the shipping space is no longer lost on many public investors. They appreciate that this is let's call it a date and not marry industry with respect to how they think about putting money to work within the shipping space. So moving along, and here's why: because for every bull case there is almost always an equal and opposite bear case. And I think oftentimes we as me, even as an analyst, and oftentimes owners that have very vested interests in the strong performance of their assets, can be anchored to the upside, to optimism. But the reality is there are oftentimes things that weigh against that. And I think that's probably the number one question I'm asked by investors, and probably the most important question they can ask is, how can I be wrong? What am I not thinking about? This is a very, if you look at, let's say, supply, dry bulk supply, tanker supply, whatever, it's relatively low, but what could go wrong? And sometimes we don't know, as Joachim was saying, coronavirus, nobody saw that coming, but what could go wrong? And there's a few things, and I'm not going to go into all of them, but if you look at the tanker space, for instance, everyone's really absent coronavirus, many people are very optimistic. But if you dig into the details a little bit and you look at where oil growth is coming from, as it turns out, prior to the recent cut by the IEA was looking for 1.2 million barrels a day of oil demand. Well, that's great. That's, let's call it 3 to 4% underlying tanker demand, except if you really dig into the fine print, of that, 0.6 million barrels was actually propane and ethane. So the IEA was saying, really, we're only expecting about 500,000 barrels a day of underlying oil demand growth, which is 1 to 2% tanker demand growth. And then if you bake in coronavirus against that, it's more of a problem. Another bull case for many tanker investors is that the U.S. is going to really drive underlying ton-mile demand growth. And that's certainly true, and I certainly agree with that. But 2021 is almost certainly going to be the peak for U.S. oil production. So you have a nice runway for the next 24 months. And then after that, unless oil prices come up a lot, you're probably not going to have that same ton-mile demand factor. So not to be negative or bearish, but I think it's important that me as an analyst and investors be aware that there are weighting factors, and that's true of all of these spaces. And I think increasingly, as investors have seen the volatility, as we were showing earlier, that they're at least cognizant and aware of the fact that things don't always go exactly to plan, and sometimes we're not looking at all of the information that dictates how underlying performance of the assets will play out. So that was just an example. So now, what do investors really care about? And this is generally true of the public, more liquid assets like equities and debt, more so than it is private equity. And this is a little bit hard to see, but the point is that in periods of time where there are not big shocks in the day rates, as was the case in dry bulk or tankers, there's not a very strong correlation between the underlying rates and the stock prices. And in general, and we'll get to this in a minute, in periods of time where there's not big moves in the rates, the equities have traded, at least for tankers and dry bulk, well below their NAVs. What does that mean? It means that if investors don't have a catalyst, don't have a reason to believe, then they don't care at all. It doesn't matter what the price is. It doesn't matter where the NAV is. It doesn't matter what supply looks like. They're indifferent. They need to have a reason to believe. They need that momentum behind them. Which certainly you can see when the rates move, there's a very tight correlation. When they move extraordinarily large moves, there's a very tight correlation between the valuation and the underlying cash flows. But when there's not, or when the rates are only moving or bouncing around the bottom, my phone turns off, and people are no longer very interested, or at least the vast majority. So what does that mean? And we'll get to this next. So what does that mean? It means that by and large, as many of you know, and this isn't necessarily true of things like containers or LNG or LPG, but you go through these periods of time where the public equities trade at big discounts for sustained periods of time to what the underlying NAV is. And why is that? Again, it's a lack of interest. People just don't care if there's not the ability to make really outsized returns in a short period of time, because most people aren't investors, they're traders. And if they can't make a trade, then they're, again, not universally true, but many of them aren't just too awfully interested in doing anything at all. They'll go invest in Amazon or something else. Now, this isn't necessarily true of the private equity universe, but I would say that the private equity universe is smaller than it used to be. And so I think there are pockets of capital that are interested in a little bit longer duration investments, but need to feel as though they're doing so with an edge or an angle. So simply, co-investing without any extra element of protection or a promote is not as interesting as it used to be for many investors. So what matters? What dictates the valuation of a lot of these investors? And the number one thing, we've run some regressions, and the most important thing is share price liquidity. So for public equity investments, if you don't have liquidity in your shares, you're not going to trade at a good valuation. It is as simple as that. If there is not a substantial enough market cap with enough average daily trading volume, there certainly are outliers, but in general, both of those lines are upward trending. And so that's probably the most important factor. The other thing that you find is, generally speaking, the better the balance sheet, the better the valuation. And then lastly, the perception of management and transparency and so forth tends to lend itself to better valuation as well. So I would note, as you can see here, that the data is somewhat disparate. So it's not a hard and fast rule, but I think all of those things are certainly part of the investment decision that many investors undertake. So again, I would, if I were advising, I would say bigger is better and cleaner is better and less debt is better. And that's simply the way that it is. Oh, and then lots and lots of compliance mumbo jumbo. So with that, hopefully I went fast enough. I think we did. Are you ready? Yeah. All right. I think we are ready to take a few questions if we have time. All right.
We have one question. Okay.
Ben, you made a differentiation for containers, the sector. How does that compare with the dry bulk and tankers?
So I would say in general, the way I would differentiate it is that at least for some of the bigger, let's say Costamare or C-SPAN or some of the bigger ones, their cash flows are where most investors are anchored rather than the underlying asset values. And so if you have an average of 8-year remaining duration on contracts, people are going to fixate on the cash flows that those contracts translate into, and NAV becomes less of a factor.
By the way, all material will be available online afterwards, so you can always go back and retrieve the presentations and listen to the other slides.
All right.
Maybe thank you very much.
Oh, wait.
One more?
Jeff?
Sorry, yes.
Yeah, hi, Ben. You wrote this morning, but this question for Jakob too, but you wrote this morning that, as an example, someone just published results. Sting may have found the bottom, but I'm not sure there's a catalyst for recovery. How long do you both think that I know you're not experts on illness or disease, but if you take a reasonable scenario for the virus, wouldn't the recovery from that be a catalyst for some of the shipping stocks to run again?
I do, although I think more importantly, and I think that it certainly could lend itself to a bounce off the bottom, no question. But before people are going to be willing to actually put incremental, let's say, non-bounce off the bottom capital to work, growth capital, trade capital, they probably are going to need a reason to believe that rates are going to do more than just sort of bounce off the bottom. So to retest previous highs, I think it's going to take more than just sort of an abatement of the coronavirus.
What do you think?
Yeah, so I think it's way too early to conclude that this is over. But again, with my graph on the second derivative, I think that's the first sign, and then the first derivative potentially becomes negative, and then we start seeing the things clear out. But it's uncertain. But our base case is, as mentioned, that this will have a positive effect on the second half. And I think if that comes into fruition, I think investors will soon forget the pains of this first half and will be eager to buy shares again. So our recommendation is for the less risk-averse investor, could be a great opportunity to pick up some stocks below net asset values, which in many segments we believe will be higher in 1 year versus today.
Yeah, I generally agree with that. I think there's companies like yours that are well run and have good valuation, and you can probably get a nice bounce off of it. But again, for the pace of investment to pick up to where it was, I mean, there's not another IMO 2020 in June, right? So need another something for people to anchor into.